What if the most important economic story of our time isn't happening on front pages, isn't debated on cable news, and isn't showing up in political sound bites, but is instead unfolding quietly, methodically, and with extraordinary patience beneath the surface of the global economy, while public attention remains fixated on trade disputes, elections, and geopolitical drama? A far more consequential strategy is being executed in plain sight, a strategy that does not rely on military force, the public ultimatums, or diplomatic theatrics, but on something far more fundamental and far more enduring: control of the physical resources that make modern civilization possible. This is not about tanks crossing borders or treaties being signed. It is about copper, lithium, silver, rare earths, nickel, cobalt, and dozens of other materials most people rarely think about, yet interact with every single day. These are the materials embedded in phones, electric vehicles, data centers, power grids, medical equipment, weapons systems, satellites, and every advanced technology shaping the future. And one country is moving with remarkable discipline to secure dominant control over them. China is no longer simply the world's factory. That characterization is outdated by decades. What Beijing has evolved into is something far more strategic. It is positioning itself as the gatekeeper of industrial civilization by systematically securing supply chains for critical materials at a global scale. This is not accidental, opportunistic, or reactive behavior. It is a long-term national strategy backed by state policy, state capital, and a clear understanding of where real power resides in the 21st century. The logic is straightforward and brutally effective. If you control the raw materials, you control who can manufacture. If you control manufacturing, you influence prices. If you influence prices, you shape economies. And if you shape economies, you exert power without ever firing a shot. This is not theory, it is history, and it is happening again, only this time with far greater sophistication and global reach. China has been executing this strategy quietly while Western nations focused on short-term growth, quarterly earnings, and election cycles. State-owned enterprises, backed by virtually unlimited financing, have been acquiring mining rights, long-term supply contracts, and strategic stockpiles across Africa, South America, Asia, and beyond. These are not speculative bets. They are deliberate acquisitions of industrial leverage. Consider the breadth of materials involved: copper, the backbone of electrical infrastructure; lithium, essential for batteries powering everything from smartphones to electric vehicles; cobalt and nickel, critical for battery stability, aerospace alloys, and advanced manufacturing; platinum group metals like platinum, palladium, and rhodium, indispensable for catalytic converters, electronics, hydrogen technologies, and chemical processing; rare earth elements, despite their obscure names, are absolutely essential for magnets in wind turbines, electric motors, missile guidance systems, and advanced medical imaging. China already controls the vast majority of global rare earth processing capacity. Even when these materials are mined elsewhere, they are often shipped to China for refinement, because that is where the infrastructure and expertise exist. Processing, not mining, is where the real choke point lies, and China understands this better than anyone. What makes this strategy especially powerful is that it is not just about supply dominance. It is also about currency transformation. For decades, China accumulated enormous reserves of US dollars by running persistent trade surpluses with the West. Now, those dollars are being systematically converted into tangible assets with intrinsic industrial value. Every ton of copper purchased, every ounce of silver stockpiled, every kilogram of lithium secured represents a dollar removed from paper reserves and used transformed into real-world leverage. If you were sitting on trillions of dollars in a currency being steadily diluted through monetary expansion, the rational response would be to convert that currency into assets that retain value and provide strategic utility. That is exactly what China is doing, and it is doing so with relentless consistency. This may ultimately be remembered as one of the largest and most consequential wealth reallocations in modern history. Trade tensions and tariffs have not slowed this process. In many ways, they have accelerated it. Reduced trade volumes mean fewer dollars flowing into China, through traditional channels. Beijing's response has not been panic or concession, it has been adaptation. Increased use of alternative currencies in trade settlements, accelerated resource acquisition, and the construction of parallel financial and trade systems that reduce dependence on Western infrastructure. This is not merely an economic story. It is a story about power, leverage, and the future structure of the global system, and it has profound implications for the US dollar. The dollar is already experiencing a structural decline, weakening significantly against a basket of major currencies. This is not a short-term fluctuation driven by sentiment. It reflects deeper changes in global trade behavior and reserve management. Historically, dollar down cycles driven by structural factors tend to last years, not months. Once they begin, they are difficult to reverse quickly because they are rooted in shifts in how the global economy functions. We are still in the early stages of such a cycle. One of the clearest illustrations of these dynamics can be seen in the silver market. Silver has undergone a dramatic transformation from a primarily monetary metal to a strategically critical industrial input. It is essential for semiconductors, solar panels, defense systems, aerospace applications, medical technologies, and the electrical grid. Demand has surged from multiple sectors simultaneously, while mining supply has failed to keep pace. The result has been an extraordinary price move, driven not by speculation alone, but by genuine supply constraints. And nowhere is this more visible than in China. Chinese investors and institutions have become acutely aware of the fragility of paper-based commodity markets, where claims on metal vastly exceed the amount of physical material available for delivery. The rational response has been a rush toward physical ownership. This has created severe shortages in China's domestic silver market and driven premiums to levels rarely seen in modern financial history. Investment vehicles have become massively oversubscribed, with investors willing to pay extraordinary premiums simply to gain exposure to physical metal. This behavior reflects fear, urgency, and a deep understanding that access to strategic materials may not be guaranteed in the future. There is no question that speculative excess has emerged. Manias, by definition, do not last forever. Corrections are inevitable, but beneath the volatility lies a durable reality. China is absorbing physical resources because it views them as foundational to its future industrial and strategic position. And silver is only one example. The same pattern is unfolding across a wide array of materials: copper for electrification, lithium and cobalt for energy storage, rare earths for electronics and defense, tungsten, chromium, manganese, molybdenum, vanadium, gallium, germanium, indium. These are not abstract commodities. They are the physical inputs of modern power. This resource strategy is unfolding alongside another major development that further pressures the global financial system. Japan. The Bank of Japan has begun raising interest rates and signaling a shift in policy after decades of ultra-loose monetary conditions. Despite these moves, the yen has remained weak, creating inflationary pressure through higher import costs. Japan's government carries an enormous debt burden, making aggressive rate hikes difficult to sustain without significant financial strain. One potential consequence is the sale of foreign assets, particularly U.S. Treasury bonds. Japan is one of the largest holders of U.S. government debt, and even partial liquidation would have meaningful implications for bond markets and the dollar. At the same time, rising Japanese rates threaten the viability of the yen carry trade. A massive and long-standing source of capital flows into U.S. assets. As the interest rate differential narrows, protrudes, the currency risk increases. Unwinding this trade becomes the rational choice. That process means capital flowing out of U.S. markets and reduced demand for dollars. These forces are not isolated. They reinforce one another. China converting dollars into resources, structural dollar weakness. Japan potentially selling treasuries. The unwind of leveraged currency trades, shifting trade settlement practices. Together, they represent a profound shift in the global financial landscape. This is not a typical market cycle that resolves with a policy adjustment or a trade agreement. It is a generational transition in how wealth is stored, how power is projected, and how the global system operates. Physical resources are gaining importance relative to paper currency. Strategic materials are becoming instruments of influence. For individuals and institutions alike, this environment demands a reassessment of long-held assumptions. Strategies that worked reliably for decades may no longer provide the same protection. Diversification is no longer just about asset classes, but about exposure to real versus financial assets, and to systems that are resilient in a changing world. The decisions being made today by governments, corporations, and investors will echo for decades. Understanding the forces at work is not optional. It is essential. This story is still unfolding, and its implications are far-reaching. What is happening beneath the surface matters far more than the distractions dominating headlines. And as this transformation continues, one truth becomes increasingly clear. Those who control the physical foundations of industrial civilization will shape the future, and those who ignore this reality do so at their own peril.